Most traders learn RSI as a simple overbought and oversold tool. Above 70, sell. Below 30, buy. If you have ever traded that rule in a real trend, you know it can bleed your account. Today we go deeper. We will rebuild RSI from its math, expose the overbought trap, and turn divergence into a precision tool for entries and exits. RSI is relative strength, smoothed. Take the average gain and average loss over your lookback, typically 14 periods, using Wilder's smoothing. Compute relative strength as average gain divided by average loss, then map it to a bounded oscillator, 100 minus 100 over 1 plus RS. The output sits between 0 and 100. Because it is a ratio of recent gains to losses, RSI measures the velocity of price changes, not their magnitude in dollars. 70 and 30 are conventions, not laws. Wilder picked them because in a sideways market, those extremes catch reversals, but context matters. In a strong uptrend, RSI can sit between 40 and 90 for weeks. In a downtrend, it rides between 10 and 60. Constance Brown's refinement is critical. Shift your bands to 40 and 80 in bull regimes, 20 and 60 in bear regimes. The zones are dynamic. Here is the trap. In a powerful uptrend, RSI hits 70 early and stays there. Traders short get stopped, short again, and bleed. Overbought is not a sell signal. It is a signal of strength. The fix is to read RSI as a trend confirmation tool first. Persistent readings above 60 confirm bullish momentum. Only fade extremes when price structure is also breaking, never on RSI alone. Divergence is where RSI earns its reputation. Bearish divergence. Price prints a higher high, but RSI prints a lower high. Buyers are losing thrust. Bullish divergence. Price prints a lower low, but RSI prints a higher low. Sellers are exhausted. The key is that divergence measures momentum decay before price confirms. It is a warning, not yet a trigger. Most traders miss this one. Hidden divergence is a continuation signal. In an uptrend, price makes a higher low, but RSI makes a lower low. That dip in momentum is just a pullback inside a strong trend, and it often marks a high-quality entry. In a downtrend, price makes a lower high while RSI makes a higher high. Use hidden divergence to add to existing trend positions, not to call reversals. Divergence alone is not an entry. You need a trigger. Wait for RSI to cross back through 50, the midline, after a divergence forms, or wait for a swing low or swing high break on price. Combining the two filters out most noise. Your stop sits beyond the divergence extreme, your first target is the prior swing. Let's validate on Apple daily candles over the last year. Watch where RSI tags overbought during a clean trend and price continues higher for weeks. Now find the bearish divergence. Price grinds to a new high while RSI rolls over. That is your warning. The trigger fires when RSI breaks 50 and the prior swing low cracks. RSI is lagging by construction. Wilder smoothing means recent prints are weighted, but you still average over 14 bars. In choppy markets, RSI ping-pongs across 50, generating false crosses. On low-volume instruments, gaps distort the average gain and loss inputs. And divergence can persist for many bars before resolving or fail entirely when a news catalyst overrides momentum. Combine RSI with tools that solve its blind spots. Pair it with the ADX to filter regime. Only trust divergence when ADX is falling, signaling momentum decay. Add volume confirmation with OBV or money flow to validate that distribution matches the divergence. Use horizontal support and resistance for the actual entry trigger. RSI tells you when, structure tells you where. 3 traps to avoid. First, shorting just because RSI is above 70 in a trending market. Second, calling divergence on every wiggle, instead of waiting for clear, comparable swing highs or lows. Third, using the same 14-period setting on every time frame. Intraday traders often prefer shorter lookbacks like 9, while swing traders sometimes lengthen to 21 for smoother signals. Tomorrow, do this. Mark your instrument's regime. Shift your RSI bands accordingly. Scan for regular divergence near key structure for reversals, hidden divergence inside trends for continuation. Wait for a 50-line cross or a structure break to trigger. Use ADX and volume as filters. That workflow turns RSI from a beginner trap into a professional edge. This is education, not financial advice. Manage your risk and trade your plan.